market is at risk of opening below the 21-day exponential moving average for the first time since April. That could mark a short-term change in market sentiment, but doesn't fundamentally alter the broader outlook. Looking ahead to July's options expiration, the setup still appears supportive. It's important to remember that the second half of June tends to be one of the weakest two-week stretches of the year. A modest pullback during this period wouldn't be unusual and still should be viewed as a reflection of normal seasonal behavior rather than a sign of deeper weakness. This is quite relevant given the dramatic headlines in the media, especially those related to geopolitics, which can easily exaggerate market fears. Seasonality tells a different story. For the first half of July, which historically is the strongest time of the year for equities, that suggests any dip into late June might present a good opportunity. If the market does continue lower, a logical downside level to monitor would be the 100-day EMA near the 5,800 mark. With seasonally weak conditions currently in place, it might make sense to consider short-term hedging. However, this is not a call to turn broadly bearish. The internal dynamics of the market do not currently support a bearish stance. In my view, the environment still favors long bias, and any hedges here should serve as protection rather than outright short exposure. The bigger risks lie not in July or June, but more likely in August. Market positioning into July still looks supportive, and that being said, the biggest threat to the near-term bullish case remains the situation in Iran. If the Strait of Hormuz were to be closed or eventually threatened, it could trigger a substantial rise in oil prices, given that over 4 million barrels a day pass through the channel. A sudden spike in oil could upset the supportive market dynamics we see today. So far, the market does not appear to take that risk seriously, despite reports that Iran has made such threats, and if the attacks don't stop, oil prices remain stable or slightly lower in pre-market trading. The lack of movement suggests investors do not yet view these threats as credible. Even betting markets have shifted, and this is pulling market, with the odds of US involvement in Iran dropping sharply after the latest White House press conference. Longer-term oil market signals also support this view. There is very, very little risk being priced into oil options, and the skew remains shallow. Even looking at global credit markets, including those in Europe and Asia, credit spreads have barely moved over the past week, and US high-yield investment-grade spreads are largely unchanged, both week on week and compared to the levels from before the geopolitical flare-up began. This stands in contrast to the VIX, which has risen about 20%, potentially creating a distorted sense of risk for investors focused solely on volatility indices. From a credit and volatility perspective, the market is not signaling any significant structural stress. Wednesday was also the VIX expiration, and the current hedging profile shows a build-up of call positioning, likely as insurance against further escalation in the Middle East. Despite this, we're still not seeing indicators of a major volatility event ahead. The VIX turn structure remains in contango, meaning traders expect volatility to remain contained and are still willing to sell it, which generally prevents sharper spikes. Supporting this, the VVIX, which measures the expected volatility of the VIX itself, has begun to cool off, suggesting fears of a major spike in market volatility are easing. Additionally, there's still noticeable divergence between the VVIX, VIX, and SVXY, which implies continued upward pressure on short volatility strategies. All of this paints a picture where a slow grind higher in volatility is possible, but the market is not bracing for a large shock, unless, of course, something major like a Strait of Hormuz closure materializes. Behind the scenes, there are also quiet forms of policy support. Although the Fed has not returned to QE or quantitative easing, the Treasury has been engaging in bond buybacks, and during bond buybacks during auctions, which is a subtle method of injecting liquidity. There's also a push to ease capital requirements on banks, specifically through changes to the standard lending ratio, SLR, which could encourage more lending and provide further economic support. These efforts reflect a broader intention to keep the US economy looking healthy, and this is particularly in light of the recent investments from the Middle East and the need to maintain confidence in US growth. In short, the next 6 weeks into July continue to look supportive overall, despite the likelihood of some short-term seasonal weakness. The period after July, particularly August and September, appears to carry more risk and will warrant closer scrutiny as we approach it. For now, maintaining a long bias with some hedges in place seems appropriate, while closely monitoring developments in the Strait of Hormuz. This is all for today. Like, share, subscribe, and see you next week.